Hello, good afternoon, and welcome to INSEAD's webinar series focused on the navigation of the fallout from the COVID-19 crisis we are right now going through or still in the middle of. Today's focus will be on private equity and its recovery plan for its portfolio companies, especially with a focus on how portfolio companies and board members and other companies can learn from it. My name is Claudia Zeisberger. I'm a professor for entrepreneurship at INSEAD and the academic director of its private equity center and private equity initiative. So on that note, it is my pleasure to welcome Graham Oldroyd, who is a friend and a dear alumnus of INSEAD as well. He was a partner for 23 years at Bridgepoint, a European mid-market buyout house, and subsequently a trustee and investment committee members for 6 years with a large LP out of Europe as well. He is a board member for several listed and private companies, 3 listed companies out of the UK and Sweden, and 3 private unlisted companies in the UK and in Belgium. So he's also a distinguished fellow at INSEAD's Private Equity Center, and we thank him, of course, for his time. Graham, welcome to this webinar. So I'm really excited to have you on board for that. You are, to set the tone a little bit, you are the chairman of the board for the UK arm of a corporate finance firm. And therefore you have quite interesting insights into what is happening right now, especially in the last 3 months during in the M&A space. So given the crisis, one could assume that deal making has come to a grinding halt. But I understand that one of the companies that you are on the board of was just sold last week. Was that an exception, or do you see more of that happening?
Claudia, hello. The transaction last week happened. It was a transaction that had been agreed pre the COVID crisis, but was waiting European Competition Authority approval. That approval was delayed because of COVID, but it came through in May, and the transaction duly completed last week. And transactions are happening. That the volume is right down, as might be imagined. But I'm involved with something else right now at board level, working where a PE fund is actually in final stages of due diligence on an acquisition. Indicative offer has been made, and all of the due diligence is being carried out through electronic data rooms, and management presentations have happened and have again been carried out as virtual presentations. So M&A activity is happening. The corporate finance firm I'm involved with is still receiving new mandates, and so things are definitely slower, but still going on.
Okay, fantastic. So before we jump into the topic for today, we have over 2,000 people signed up for this webinar. And we thought we wanted to understand a little bit better what made you sign up for it. So allow me to launch a quick poll. Please have a look at those questions below, and just choose whichever option basically most represents yourself. I will share the result with everyone in 2 minutes. Okay, so we have quite a few people from private equity on board. That's good to see. And of course, quite a few board members, given that this was the target of the talk as well. And well, and over 90% of you are working from home. I'd really like to know what those that none of the above are, where they are working from, but we'll come to that at one point. So thank you very much for sharing the poll. What we would like to do now, we will kick off today with a brief introduction before I hand over to Graham to run the show. and we can start sharing the slides. Okay, so let me just basically set the scene a little bit. Private capital markets versus public markets. So today our focus very much will be on those companies that are not publicly listed, but owned by private equity firm. So next slide. And as you can see, those companies owned by private equity have since 2000 grown substantially, thereby outpacing public market equities. So I thought I should start with a slide just to put it a little bit into perspective, how far the industry has come. You can skip to the next slide. So the private equity investment model it's a simple model. And all of you that were in my class will remember this slide. You buy, you improve, and you sell. So no offense to everyone in private equity, but this is literally the core, the essence of private equity. So we can continue. Obviously, there's a lot more to be said about it, and this will go way beyond the target of today's talk. But let's consider private equity as a governance structure that brings not just financing to private firms, but operational improvement, has managerial impact, in addition to the financial injections, obviously. So we can skip to the next slide. Right now, I mean, looking at the industry as we are right now in 2020, the talking point for years has been the growing pot of dry powder. Dry powder is an industry term for money, capital that has been raised from institutional investors, but is still waiting to be deployed. So as of end of 2019, we had about 1.5 trillion US dollars sitting on the sidelines, waiting to be deployed in private equity. This is a record number for the industry. Nevertheless, in terms of percentage of total AUM, as you saw, the industry itself has grown quite a bit. It remains somewhere between 30 and 35% out of total AUM. We can go to the next slide. Nevertheless, you will also appreciate that obviously having quite a bit of money sitting on the sidelines looking for good deals to invest in has had an impact on acquisition prices. So acquisition prices for LBOs, mergers and acquisitions, have obviously gone up. More people showing up to the same deal obviously drives prices up. To give a global average, if I dare to do so, somewhere around 10 to 11 times EBITDA it was pretty much was the price point at which deals were done in the leveraged buyout space, with a commensurate amount of debt to it as well. Next slide, please. Now, one point I wanted to mention as well, a recent report basically showed that especially in the US, buyout returns have converged more and more with public equities. In the past, the story of private equity very often was that private equity returns beat public market returns. And yes, that was the case in the past when one looked across leveraged buyouts. But in the last 5 years, we've seen that gap shrink. We can go to my last slide. Nevertheless, this kind of convergence of returns between public equity LBO returns and public equity returns and LBO returns is very much a US phenomenon. It's something that we don't see quite yet in Europe, neither in Asia. So there's a lot more to be said about the industry, but at this point, I would like to just basically set the scene, and I would like to hand over and share my slides and let Graham share his slides. In terms of structure, what we have in mind for today's session, we prepared a few slides to set the scene and to start discussions going. I can see I have questions already come in from the on the Q&A function. Please continue to submit your questions. We would like to hear them, and I will occasionally interject and ask Graham and communicate the questions to him. Graham, on that, over to you, please.
Okay, thank you. So I'll now take over the screen. Okay.
You should be able to share your slides.
So thank you, Claudia. 2019 now feel like a very distant memory, but for many companies, it was a good year. So at the start of 2020, COVID-19 was in general being thought of as a problem in China. That is, if it was being thought of as a problem at all. PE-backed businesses in Europe and further afield typically began 2020 budgeting for further growth, certainly not pandemic. So for the purpose of our discussion, it's helpful to consider the impact of COVID-19 in 3 phases. For many businesses, the onset of the virus was really quite sudden. The virus clearly hit some countries earlier than others. For some, this then gave a few weeks warning of what might be to come, but no one could be sure. Lockdowns and social distancing measures then caused revenue for many businesses to fall off a cliff. All businesses essentially could do was react. The next phase has been recover, survive the collapse in revenue, but also establish a new operating platform. Looking further forward, we can rebuild. The businesses I'm involved with are still very much in the recover phase. So it's useful to recap briefly how private equity worked with their portfolio companies in phase 1 when COVID-19 first took hold. So we have here a slide, and it's detailing literally it was the case of reacting. PE-backed businesses were as affected by COVID-19 as much as any other. The main initial actions by PE have been to establish structured crisis management. Within this, as with any other business, a first priority has been safety of clients and of personnel. Next has been supporting company communication, and that's meant in all directions, and a lot of it. Businesses have generally learned it is much better to say, we don't know yet, but we're working on it, than it has been to say nothing at all. Constantly changing circumstances have necessitated day-by-day replanning of sales and operations. Now, as one example, PE-backed firms were among the first to introduce red and blue team working. Simply, staff are assigned to work in either a red team or a blue team. The teams then come into work on alternate days or in alternate shifts, but they do not meet. If a red team member falls ill, only he or she and other red team members need to self-isolate. The blue team can still keep working and the company can still function. Even this turned out, though, not to be as simple as it sounds. Staff members living in the same household can obviously be assigned to the same color team. But what about those hidden relationships where one member of staff is going out with another and maybe only a few friends know? They need to be on the same color team. But what if they're not? And who tells the boss? So COVID-19 has certainly created some surprises. While all the above has been happening to support sales and operations, the main focus of PE in phase 1 has been on liquidity. Put bluntly, that is all about ensuring portfolio companies have enough cash to survive. PE has typically encouraged portfolio companies to draw down all funding lines to the maximum possible extent. Facing the unknown, the principle has been you simply cannot have too much cash. If it's drawn down, you know you have it. Undrawn, is there a material adverse change clause, or is there some other reason a so-called approved facility may not actually be able to be accessed just when it's most needed? So all the time working on liquidity, PE has given practical help to companies, tighten working capital management, cut discretionary spend, institute additional cash controls, and access government support schemes, and dramatically improve cash forecasting and reporting. All of this has been about re-establishing a new operating rhythm, even with home working, even with factory and store closures. Note the emphasis has simply been on keeping clients and employees safe and securing the continuity of the company. It's not been about profits. We've now moved through this.
Maybe Graham, before we jump into phase two, I have some questions that are coming in here with regards to the roles of boards as well. So your role, I mean, given that you are on several boards, has changed quite a bit as a board member. I would assume it was quite different in 2019 compared to 2020. So there's several questions around that. So tell us a little bit about that, and how did you manage your time? So with regards to probably several emergency board meetings.
Well, you're certainly right about the emergency board meetings. It varies very much company by company. COVID-19 has certainly hit different companies in very different ways. Sorry, I'm going to go, we've clicked a slide here by accident. Never mind. And the consequence of that is that each company has had to decide and react to different circumstances. And lockdowns have swept through Europe on different timings in different companies, so that accordingly, if your company is operating in more than one market, more than one country, then what goes for one certainly probably doesn't go for another. And it's been a case of considerable number of meetings. And as well as that, a lot of work being done outside those meetings, a lot of phone calls just to react to new situations. So you're right. Before COVID-19, it was the regular run of fairly regular scheduled board meetings. Now almost every week is still different.
Okay, I have one more question, and that was with regards to the comment that you made with regards to accessing government boards, government support schemes. So we have one question asking about your views on the challenges that PE firms may have had in accessing some of those support schemes. So in the US, PPP, CBILS in the UK, and so on. So should PE for its portfolio firms access those pools, those funding pools, or should they be kept for truly, the wording is truly private companies, which I guess they still are, but given that they're private equity owned, should this still be the case?
Well, it really does depend on the nature of the schemes. So certainly in some countries, schemes have been targeted very much at small enterprises. Private equity-backed companies still have owners. The owners are pension funds in the main, insurance companies, other investors in private equity firms. And the return on those fund investments actually will ultimately affect people's pensions. So in some ways, private equity, is like any other shareholder. It certainly will benefit in maintaining the employment through the government support. Where the government support is in job retention, furlough arrangements in the UK and elsewhere, then actually private equity firms have been able to access those arrangements just as any other firm. So yes, there can be moral arguments, and certainly private equity shouldn't be crowding out where it is the support is really being targeted at single owner enterprises. But in the main, that hasn't been the case.
Okay. So I think we jump on with phase two, and I will keep an eye on more questions coming in as they are readily streaming in. Thank you.
Okay. So sales declines have been serious, but however bad, they've at least established to some degree a sort of new stable base. Companies being able to take back some control over the day-to-day situation, and instead of this company being controlled by the circumstances. Private equities recognize that with continuing uncertainty, communication continues to be key. And that means the clients and customers, suppliers, distributors, board, senior staff and employees, shareholders, finance providers, government and community. And when you finish the list, you start at the top and you keep going all over again and again and again. Now, in one company where I'm working, there's been feedback from staff that there's actually better communication now using video conferencing than there ever was before COVID-19. Here, there are regular compulsory, regular daily team meetings, weekly department meetings, bi-weekly business unit and ND calls, monthly CEO all-staff briefings, regular board meetings, shareholder briefings, and around all these, daily senior management team calls. Now you might say, well, that should have been going on anyway, and well, it might. The difference now with COVID-19 in general, however, is that all of those meetings happen at fixed times and are fully attended, with no one there missing because they're outside at some other meeting. That's meant actually a building of team spirit and better communications across companies. Now, let's see if we can get this down. Here we go. The emphasis on liquidity is very much still present. Immediate financing needs hopefully have been addressed, but PE is then working with portfolio companies to look at funding adequacy through the whole of 2020 and into 2021. Payments for that have for the time being been deferred, but at some point still need to be paid. What are the working capital requirements? The new stock and receivables if lockdowns are lifted and sales start to recover? Is there a risk of late payments and bad debts? What should be the new debtor days assumption? What would be the financial consequences if lockdowns have to be reintroduced? So there are numerous uncertainties. PE will be working with CFOs and CEOs, analyzing multiple scenarios. PE will also be working with the Chief Commercial Officer, Chief Operations Officer, and wider executive team, looking very carefully at sales forecasts and order pipelines, and helping companies to reconfigure operations to be able to cope with a range of scenarios. Now this slide, which is based on a recent board pack presentation, illustrates some of the many steps that may have to be being taken to bring sites back into operation under COVID-19. Regulations vary by country, and indeed in some countries, even by district. Each site has to be individually assessed. It is detailed, painstaking work. It's not just a case of supplying personal protective equipment. Operating practices are having to be redesigned and changed. Private equity is at least able to share experience gained at one company with other portfolio companies. Now this photograph shows fit out in progress at one of the new UK emergency so-called Nightingale hospitals just 3 weeks ago. And this is a reconfigured warehouse with widened access areas. Against a continuing background of uncertainty, building agility into operations to cope with different possible situations has now become a major focus. Now, PE's response to COVID-19 in this recover phase has become multifaceted. It typically covers the 6 interlinked areas shown. Most large private equity firms employ operating partners. These operating partners are typically experienced executives drawn from the corporate world. Operating partners, or if there are no operating partners, the deal partners and PE executives will be working closely with the CEO and CFO in addressing COVID-19. Now, in normal times, it's very common for PE to establish a project management office, or PMO, inside companies to help manage any transformation program that's being run inside the business. Now, an example might be converting production to lean manufacturing. The PMO will carry out detailed project planning, track and report progress, and coordinate activities across the company to ensure the projects are delivered on time and on budget. PE are now widely using the PMO structure to run COVID-19 crisis management. This means each activity can be established as a separate monitored work stream. Importantly, the senior executive team, CEO and board, have information from the PMO immediately to hand, and any slippages or problems can be quickly addressed. One key output is a 21-day receipts and payments forecast, showing both the cash position and total liquidity headroom, adding in any as yet undrawn facilities. Obviously, this is a key tool in managing day-to-day liquidity, giving advance warning if special action may need to be taken. If liquidity is tight, this 21-day cash forecast will be run on a rolling basis and updated daily. The 21-day cash forecast will also be supplemented by a 13-week forecast, updated weekly. This 13-week forecast tends to be the most useful tool for board discussion. It's likely to be a mandatory inclusion in PE portfolio company board packs. Now, operating partners will also then be working with the CEO, CFO, Chief Commercial Officer, Chief Operations Officer, and the wider executive management team to look at the 12-month cash situation, 12-month cash forecasting, and the resulting company financing requirement. For this, different COVID-19 assumptions will no doubt create many different outcomes. This is one scenario. There'll be another, and there'll be another, and possibly many more. Individually, any single scenario may not be much use in such uncertain times, but together, they can enable a company to judge it as enough cash resources to weather most circumstances. Also, critically, the forecasts help management to model the likely financial consequences of different routes of coming out of lockdown. Then, working with the COO, you have the tools to look at production scheduling to give best coverage for different situations as the pandemic continues. Does production need to be reconfigured? Almost certainly yes. Is wider restructuring also going to be necessary?
So Graham, I have a question on this particular slide, which relates also to boards. So first, I mean, you mentioned operating partners. So I would assume there will be a bit of a shortage of good operating partners in PE firms, because the crisis obviously has nudged potentially several of the portfolio companies into a situation where such a partner would be well received. Is this a fair assumption?
Certainly, the operating partners are extremely busy at the moment. The other thing that has happened, though, is that new deal activity is right down. And this is allowing the deal partners also to work much more closely with company boards. They may not necessarily have the full operating partner background, but certainly they will be able to assist. And the junior staff within the private equity firms will certainly be helping considerably on getting companies moving on this financial analysis.
Okay. And one question with regards to kind of potential tensions arising. If management and board members don't agree on the right measures, should board members insist, or should they give way to management, given that they are the ones on the ground and may have maybe closer to the business?
Well, I think this is where close communication is so key, because with good communication and good information, then hopefully the number of occasions where this kind of disagreement goes on should be few. If it does happen, then the private equity will be very concerned to work with the chairman and the CEO on getting a proper agreement. Again, that's the proper functioning of the board. So, but in general, it's a case of everybody, if you've got good information, then how to react should be fairly logical.
Yeah, it's all hands on deck. There was one follow-on question to the earlier conversation we had with regards to accessing government funding, but also accessing any external funding. And the question was around private equity. So as I showed the dry powder slide, if private equity has so much dry powder, why would it not take some of that and basically inject it into its portfolio companies? So rather than trying to get funding that may be difficult to get and may also be expensive.
Certainly private equity may be able to inject further equity capital. One of the issues it will have is that very often the new money ready for investment is actually in a different fund than the existing portfolio companies. So the existing fund may already be relatively fully invested with very little capital remaining. And the new commitments have been raised in an entirely different fund. And very often it's not possible to move cash from one fund, a new fund, into investments which were made by prior funds, because there are frankly different investors. It's very difficult indeed to mix those two groupings.
Right. So structural issues, one could say. Okay, we'll jump to the next slide. Thank you.
Thank you. Now, another area critically is the commercial side. PE will be helping portfolio companies reassess their market. This will not just be the immediate market situation. The company itself will know that very well, perhaps all too well. The whether and how markets may change as the pandemic progresses. Coming out of lockdown, demand may be unusually strong just for certain products and services and very weak or non-existent for others. But can this be anticipated? After the pandemic, will the market have permanently changed, and how? Now, under COVID-19, every sector is going to have its winners and its losers. Private equity funds are alert that this may provide a suitable environment for opportunistic M&A. They'll be thinking what could be a good deal. And remember, as we've just discussed, PE funds have considerable cash to invest. But what investment might, however, just be catching a falling knife? So right now, I'm personally aware of one PE firm who's just commissioned a significant paid-for search for possible acquisition targets. And this is in order to continue a buy and build strategy for an existing portfolio company. Now, the company has a very strong management team. And while the sector is known to be struggling now, the PE fund feels the team is well set to be the industry consolidator and likely to be the winner with excellent growth prospects post-COVID-19.
So actually, Graham, I have a question on that point exactly. So the question is along, how do you balance this decision? What are the key factors to consider when thinking during a COVID recovery phase to kind of double down on an investment, i.e., like you said, a buy and build platform, so basically do a small roll up around an existing asset, or whether to rather, not basically throw, let's call it good money after bad. So how do you balance it? How would a PE fund think about that?
There are multiple factors the PE fund will be taking into account. Primarily, it will depend on the individual company and the PE fund's assessment of that market opportunity. However, other factors can influence this. It can be at what stage is the fund, is that particular fund at in its lifetime. PE funds have typically a 10-year life, and it's very difficult to be drawing in further money in years 6 and 7 if the investment from that isn't going to provide a return in time by the time the portfolio company needs to be sold and proceeds returned to fund investors. So timing in the fund can be an influence. And then critically as well, the management team. Private equity will be looking at the management team and saying, right, if we do this major transaction, has the team got the bandwidth to cope with this at the same time as dealing with all of the issues currently in COVID-19? So multiple factors will come into consideration, but generally private equity will be keen to put further money behind a good team if there is an opportunity there.
Thank you.
So the next area is all of this goes to revised exit planning. PE portfolio companies adversely affected by COVID-19 that might otherwise have been planned to be sold or put forward for an IPO in 2020 may now be held for much longer. On the other hand, sales of companies who've quietly done well under COVID-19 may actually be brought forward. Either way, previous exit plans will be being carefully reconsidered on a case-by-case basis for each portfolio company. Now, this will be strongly influenced by the market assessment and M&A assessment. One key aspect of the private equity model is the creation of management incentives designed to align management interests closely with those of the PE fund. Now, typically, this will be some form of direct equity incentive, with management proceeds then linked to the value of the company achieved on exit. Now, there's no doubt that COVID-19 is creating a dilemma for some PE funds on what to do with management incentives. Values of some portfolio companies are sharply down. Exit timescales are likely to be pushed out, and fund returns are down. Now, normally, aligned incentives is not just upside. It also means management are expected to take the rough with the smooth. However, private equity also knows it needs to keep good managers. Many equity incentive structures are now potentially so underwater that there is no incentive. And in private equity, this will be particularly the case if the structure has what's called a ratchet. Now, this is an arrangement whereby incentives start very low, but shoot up disproportionately on beating one or more thresholds. Now, those thresholds may simply now be out of reach. In many cases, it's too early yet for detailed conversations on incentives. Nevertheless, PE funds are already beginning to make soft promises to key managers that incentive arrangements will be reviewed and reset. Now, under resetting, potential upsides will not be as rich as they possibly once were. PE will still, however, be keen to recreate a position where the interests of management are once again aligned with those of the PE fund, and that means in regrowing the value of the portfolio companies. As companies come to the end of the recover phase and get ready to rebuild, incentives will be a key agenda item. And it's not just for management. The private equity firm will be wanting that to cascade down through the companies, setting new bonus targets, sales targets. There will have to be new norms for these. The final area of recover is preparing to rebuild. Our PE focus will always have one eye on the future, returning companies to health and creating value for fund investors. How then might you summarize PE's response to COVID-19? In many ways, it's been similar to other shareholder groups, but perhaps with much closer involvement with management and executives. on the one hand, it's been about providing some very practical help to portfolio companies at a micro level. At the same time, keeping a focus on cash and ensuring companies maintain adequate liquidity. It's also been about keeping a firm eye on the longer term future, helping portfolio companies be ready to rebuild. And in particular, making sure that actions now that might be considered expedient under COVID-19 don't destroy or at least hinder the rebuild of the company. It's been about anticipating how markets will change and then beginning already to review exit planning. And everything's being done with the ultimate aim of recovering and building value for private equity fund investors.
So, Graham, one question that keeps coming up in one form or the other. Whilst I think we're at the end now, we can unshare the slides now. One question has been coming up with everything going on with COVID. What is, how do you see the process of private equity changing from kind of operations on the shop floor to the way deals are being done? I mean, will new technologies like AI influence the way things are being executed? Has COVID kind of accelerated that process potentially? I'm
not sure it has. I think COVID has happened so quickly that the private equity working model has had to pivot very, very substantially just to concentrate on working with the portfolio companies and seeing them through COVID-19. I think when transaction activity returns, the knee-jerk reaction of most private equity funds will be to just reinstitute their previous investment committee and normal processes. So I don't think AI will necessarily sort of have a greater involvement going forward than it has now. It's one of those things that is coming. And this is in particular using AI to screen investment opportunities and help with the assessment. What I do think is going to happen is I do think there's going to be an enormous amount more use of video conferencing going forward. Home working may well become more of a feature. And I think that's just the same for other businesses outside private equity. And I think it may change due diligence processes so that, again, kicking the tires on the ground will still be very much de rigueur, but there will be more and greater use still of virtual data rooms and management video conferences for management presentations.
Yeah. I had conversations even with some LPs that are trying to get comfortable with the fact to allocate to new GPs for their portfolio without visiting offices, which right now is unfortunately not possible yet, but they're working on that. So there may be some changes. I have one question. So as we saw, several PE-owned firms in the US particularly have quite visibly gone into Chapter 11 just in the last few weeks. And to be honest, I expect this just to be the beginning of potentially a future wave just in term for my turnaround elective. Is this a US specific issue? Should we just expect that several of those firms will be private equity owned? What's your view on that?
I think you certainly can expect that certain of the firms will be private equity owned. It's not because they're private equity owned. I think if you look at the COVID-19 is affecting all businesses, and in certain sectors are being very, very badly hit. And then if there's leverage, then it becomes even more difficult. The situation in the US, some very high profile Chapter 11 announcements. Europe doesn't have the same, quite the same Chapter 11 structure, and the administration, receivership, insolvency arrangements across Europe vary country by country. So some of those don't give the same protections that Chapter 11 does in the US. So in one way, Chapter 11 can be considered as a sort of protection to a company to allow it to reconfigure and then come out alive and still employing people at the end of the process. But I do think, yes, unfortunately, COVID-19 is going to cause some company failures, and undoubtedly some PE firms will be part of that.
And let me just have a look at my at some questions. There's a question around your view on M&A, on the M&A deal pricing impact on COVID. Do the prices in M&A, you said deals were still going on, or do you expect them to kind of follow the public share pricing? So can we expect prices to be off 20%, 30%, even though I can't imagine private equity being as volatile as the public markets right now.
Well, private equity isn't, but that's the reason. The reason for that is that the lack of volatility on the private equity share pricing is that the pricing isn't done on a daily basis, and there is the lag, and the lag creates a smoothing effect. In terms of valuation, multiple valuation measures are being used, and what is the interesting challenge is that you can. It's the real question is if you're using earnings multiples, what earnings do you base those multiples on? And one of the approaches that definitely doesn't work is to say, well, multiples have you need to apply a lower multiple because we're in COVID-19, and then again you apply that lower multiple to a lower current earnings number, and you're doubling up on the bad news if you were to take that approach. So by all means, take a lower earnings multiple and then take a normalized earnings, or take a earnings forecast, and then you've got to be very careful on what base you assume that forecast is based on, and then apply perhaps a more cautious earnings multiple. The quoted markets are a very, very important comparable in setting private company valuations. And the British Venture Capital Association rules, the European Venture Capital Association rules sort of require this look across into public markets. So definitely on the year-end valuations in private equity portfolios in Europe, there are going to be some major adjustments. And certainly the fall in the stock markets, wherever they are at the year-end, is going to be an influence on private equity fund portfolio valuations.
Yeah.
But I can say for individual acquisition cases, it is always the case that it's a willing buyer and a willing seller, and the price on any individual transaction will affect that be affected very, very strongly by that dynamic, and also whether there is any tension in the auction with other participants or not.
Yeah, so it will be interesting how my chart will look like when we look back in 2021 and look at the pricing of the deals done during 2020. On that note, you touched on it. Let's have a look at debt, because obviously that plays a major role in the leverage buyout space. Do you expect there are going to be serious challenges in private equity raising new debt, and at the same level as it has been able to do so, I would say, over the last 5, if not 8 years, since the last global financial crisis?
I don't think there's going to be a huge problem in raising debt. I think the quantum will be lower. So I think that it's going to be natural for debt finance providers to be relatively cautious on initial earnings forecasts for companies. And that's going to be reflected in debt offers at lower EBITDA multiples. And private equity firms themselves may be wanting to exercise, again, some caution themselves in where those forecasts are and the amount of leverage that's taken on. One advantage of covenant light and no covenant debt situations that has been a recent trend has been, in fact, that it has provided sensible breathing space for companies to get to a stabilized position during COVID-19. And indeed, it should be the case, I think, that there will be some tightening of covenants and bringing back a stricter covenant positions going forward, perhaps in a tighter debt market. But in general, actually, the weaker covenant position, in some senses, has been a good thing in allowing companies to trade through the huge volatility that's been created by COVID-19. It's more suitable for a stable growth environment.
And so one final question, what, in your opinion, are the industries that will benefit from this crisis, and which ones will be the losers? So we won't hold you to that, but if you want to give it a stab.
I think that the ones that have lost out are the ones that are very obvious. So, aerospace, hospitality industry sectors, direct retail, non-food retail, non-grocery retail, all of those have obviously taken a big hit, and it's going to be very hard to see them getting a speedy recovery. They may be one of the last to benefit as lockdowns get lifted. There have been some surprise winners under COVID-19. I mean, who would have thought that if you were a bicycle manufacturer in the UK, the onset of COVID-19 would be pushing up your revenues 30, 50%, simply because that's what everybody wants right now. So I think some imagination is needed to look across at individual sectors that may be winners. I think the other area is that life will get back to normal, and then it's businesses. It's the usual businesses that have good management teams, innovative products, and provide good services to their customers that are going to be the winners.
Okay, so thank you very much, Graham. Thank you for connecting with me, you in London, me in Singapore, and for putting this very, very thought-provoking presentation together. I have another 80 questions hanging there, so I apologize to all the alumni that handed in the questions, and unfortunately, we couldn't quite make it to it. So I think we have a few more slides to show for the end. I would like to thank everyone. I can also tell that we had literally no attrition throughout the seminar, which I guess is a good sign, and with so many questions coming in. I would like to thank our lifelong learning team for putting this together. So Aneth and her team, and Perrine with all the technical team behind it as well as I'd like to thank the GPEI team for helping me manage the avalanche of questions behind the scenes. So it's always good to stay basically on top of that. On that note, as you could tell as well, my trusty ring light has given up. So clearly I'm spending too much time on Zoom, and with a big thunderstorm about to happen outside, it has become a bit dark. I would like to thank everyone, and we look forward to seeing you at one of the future webinars as well. And thank you, and please give us your feedback. The slides will be available, the recording will be available as well in a few days' time. So any further questions you may have, please do submit them, and we will try to circle back and address them. Thank you very much to everyone, and have a good evening, or have a good day if you're in Europe, or a good morning for those of you in the US.